Hello, students. A very, very good evening to all of you. So, today we'll revise our chapter number 21 non resident taxation. Okay, so let's start. Okay, so to start with, it has the rules to determine residential status. So, firstly, we'll quickly revise the rule for the determine residential status of individual, right? So, in case of individual, an individual is said to be resident if he satisfies any one of the following two conditions. And what are these two conditions? We call it basic conditions. What are these? One, he is in India for 182 days or more during the relevant previous year, or he is in India for 60 days or more during the relevant previous year, and he has been in India for 365 days or more during 4 years immediately preceding the relevant previous year. Right? So either if during the relevant previous year, if the person is in India for 182 days or more, then he's a resident. Or if he's in India during the relevant previous year for 60 days, and in the last 4 years, he was in India for at least 365 days. If it satisfies both these conditions, 60 days and 365 days, then also he will qualify as resident. So a person may satisfy any one of these two conditions, then he will be treated as resident. Okay. However, the condition number two, 60 plus 365 days, not applicable, is not applicable in respect of three category of person. First, an Indian citizen who leaves India during the relevant previous year as a for employment outside India. Or second, an Indian citizen who leaves India during the relevant previous year as a member of crew of Indian ship. And thirdly, an Indian citizen or person of Indian origin who being outside India visit India during the relevant previous year. So for these three persons, they shall qualify as resident only if they satisfy the condition number one. That is, they are in India for 182 days or more during the relevant previous year. Okay? Okay. When we talk about the stay, then it is not necessary that the stay of individual is continuous. Stay in India includes stay in territorial water of India, and the day of arrival and day of departure is considered as stay in India. Okay. Now, in respect of third category, which is an Indian citizen or person of Indian origin, who being outside India visit India during the previous year, such category is considered as a resident in India if he satisfy the condition number one, that is, he is in India for 182 days or more. However, it says if the total income other than income from foreign source of such person exceeds 15 lakh, then such person shall be deemed to be resident if he is in India for 182 days or more during the relevant previous year, or he is in India for 120 days or more during the relevant previous year, and 365 days or more during 4 years immediately preceding the relevant previous year. What it says, in case of an individual who is citizen of India or person of Indian origin, is having a total income other than income from foreign sources exceeding 15 lakh in a previous year, and being outside India visit India during such year, the condition number two shall apply as if for the word 60 days, the word 120 days have been substituted. So for these type of individual, they will qualify resident if they are in India for 182 days or more during the relevant previous year, or during the relevant previous year their stay is 120 days or more, and in the last 4 years they were in India for 365 days or more. Clear? But if the individual qualifies resident on account of satisfaction of condition number two, then he shall always be RMOR irrespective of the additional condition. Such individual shall be deemed to be RNOR if his stay in India during such years less than 182 days, even if he satisfies the additional condition prescribed under section 6. Clear? Now, the expression for this 15 lakh, we have to see the total income other than income from foreign sources. So the income from foreign sources means income which accrue or arise outside India, except income from business controlled from a profession set up in India and which is not deemed to accrue or arise in India. Right? So for computing this 15 lakh rupees, we have to take all Indian income, income which is accruing or arising in India, plus an income which accrue outside India, made from a business controlled from corporation set up in India. So these two income has to be aggregated to see whether the limit of 15 lakh is satisfied or not. Okay. A person is said to be of Indian origin if he, either of his parents or any of his grandparents were born in undivided India. Like deemed resident section 618. So it says an individual being a citizen of India, having a total income other than income from foreign sources, same thing, exceeding 15 lakh in a previous year, he shall be deemed to be resident in India. He shall be deemed to be resident in such year if he is not liable to tax in any other country by reason of his domicile, residence, or any other similar criteria. Clear? So, if the individual is an Indian citizen, his income, Indian income plus income from business control from India, professional setup in India, exceeds 15 lakh rupees, and he is not liable to tax in any other country, then he shall be deemed to be resident of India. Even if, mind it, even if his stay in India during the regular previous year is nil. So deemed residency arises, may arise even if the stay of India of the person is zero, still such person may become a deemed resident. However, the provision of deemed residence shall apply only, it shall not apply to individual who qualifies to be resident under section 6.1, the basic condition. Okay. However, deemed resident, such individual who is deemed as resident under 6.1a shall be deemed to be RNOR. It shall always be deemed to be RNOR, even if it satisfies the additional condition prescribed under section 6. Right? Now, a person is said to be liable to tax in a country if there is an income tax liability on such person under the laws of such country for the time being in force. So, if any person is liable to income tax as per the law of the foreign country, then he is said to be liable to tax in such country. But it also includes a person who has subsequently been exempted from such liability under the laws of that country. So, if first the liability on income tax is there on anyone on person, but subsequently the government exempts such person from the income tax of such country, then also such person shall be continue to be liable to tax, shall be said to be liable to tax in such country. And provision section 6.1 is not applicable. So the fact that subsequently any person has been exempted from the income tax liability of the foreign country will not make him not liable to tax. He will continue to be liable to tax in such foreign country. Okay. Now additional condition. Additional condition is to be seen only if when the person qualifies resident under section 6.1. If a person qualifies non-resident, then there is no need to come to 6.6. So if a person qualifies resident under 6.1, then we have to see whether he qualifies as ROR or RNOR. An individual being a resident in India shall be said to be ROR. He shall be deemed to be ROR in India if he satisfies both the following additional conditions. If such individual satisfies both the additional conditions, then he shall be said to be ROR. What are the additional conditions? He has been resident in India in at least 2 out of last 10 years immediately preceding the relevant previous year. So if you are resident at least in 2 years out of the last 10 years, and he has been in India for 730 days or more during 7 years immediately preceding the relevant previous year. So If any person who qualified to be resident under Section 6(1), if such person satisfy both these conditions, then only he shall be treated as ROR, resident and ordinary resident. If he does not satisfy even one or both of these conditions, then he shall be treated as RNOR. Clear? And what are these conditions? That he should be resident in at least 2 years in the preceding last 10 years, and his stay in India should be at least 730 days in the last 7 preceding years. Okay. So, if you satisfy both these conditions, you are ROR. If you doesn't satisfy one or both these conditions, then you are RNOR. Now, member of crew of a ship. In case of an individual being a citizen of India and member of crew of a ship, so a benefit is given to Indian citizen. The following period in respect of eligible voyage shall not be considered as period of stay in India. So while computing the period of stay, the following period, which we discuss in a minute, this following period shall not be considered as a stay in India. Period. The period commencing from the date entered into continuous discharge certificate CDC in respect of joining the ship by the said individual for the eligible voyage, and ending with the date entered into such certificate in respect of signing off by that individual from the ship in respect of such voyage. Clear? The day he entered the ship, he joined the ship, and the day he left the ship, the period between these 2 days shall be considered as stay outside India. Eligible voyage shall mean voyage undertaken by a ship engaged in the carriage of passenger or freight in international traffic. What do you mean by eligible voyage? Eligible voyage shall mean a voyage undertaken by a ship engaged in the carriage of passenger or freight in international traffic. What do you mean by international traffic? International traffic means where the voyage originated from any port in India. If the voyage of the ship originated from any port in India, then it has its destination any port outside India. Or if the voyage is originated from any port outside India, it has as its destination any port in India. Okay? So if an Indian citizen is a member of a crew of a ship, and the ship is into the eligible voyage, then the period he joined the ship and the period he left the ship as stated in the CDC, the period between these 2 days shall be treated as a stay outside India. This was all about the registered status of individual. Now we are moving to the registered status of HUF. So HUF is said to be resident in India if any part of its control and management of its affairs situated in India during the previous year. So if even a small part of its control management situated in India during the previous year, the HUF shall said to be resident in India. But for HUF to become a non-resident, so it says a HUF is said to be non-resident if control management of its affairs is situated wholly outside India during the previous year. So HUF shall be considered non-resident if its affairs are situated wholly outside India. So even if a part of the control and management is situated in India, then the HUF shall be treated as resident. But to become non-resident, the whole of the control or management of its affairs should be situated outside India. So by the word control management, we mean the brain, the person who are actually taking the key commercial decision in respect of HUF. Now, if the HUF qualifies as resident, that is, if any part of its control management is in India during the previous year, then we have to see whether it qualifies as ROR or RNOR. So, a HUF being a resident in India shall be said to be resident and ordinary resident in India if the Karta of the HUF satisfies both the conditions. So, if Karta of the HUF satisfies both the conditions as discussed below, then the HUF shall be treated as ROR. If Karta does not satisfy even one or both the 2 conditions, then the HUF shall be said to be RNOR. Okay. Now, what are 2 conditions? It's same as we discussed, that Karta has been resident in India for at least 2 out of the last 10 preceding years, and He has been in India for 730 days or more during the 7 years immediately preceding the relevant previous year. If Karta satisfies both these conditions, then the HUF shall be ROR. If Karta fails to satisfy one of both these conditions, then the HUF shall be RNOR. Right? So it says registered status of HUF. First, you have to ask the question whether the control management of its affairs situated wholly or partly in India. If answer is yes, means even the part of the control management situated in India, then the HUF is resident. If the answer is no, that not even a part of his control management situated in India, then the HUF is NR for sure. But if any part of control management situated in India, then we have to see whether the Kalka satisfy the additional conditions. And what are additional conditions? Is Kalka resident in India for at least 2 out of 10 previous year preceding the previous year? And is his stay in India during the last 7 years is 730 days or more? If answer to both this question is yes, then the HUF is ROR. If answer of any one of this question is no, or both of this question is no, then the HUF is RNOR. Clear? Now we move to registered status of any other person, firm, AOP, BOI. So similar to HUF, they shall be said to be resident if any part of their control management is situated in India during the relevant previous year. That is, even if a part of their control management is situated in India, they shall qualify resident in India during such year. However, if whole of the control management of its affairs situated outside India, then such AOP, BOI firm or sector shall be treated as non-resident. A firm is said to be non-resident if control management of its affairs situated wholly outside India during the relevant previous year. Right? Now, lastly, company. The registered status of a company. A company is said to be resident. A corporate entity is said to be resident if it's an Indian company, meaning it's incorporated under the Indian Companies Act 1956 or Companies Act 2030, meaning it's incorporated under the Indian Companies Act. But Indian company is always a resident company, resident in India, right? Or in any other case, his place of effective management, POEM, is in India in that year. Right? So if his place of effective management in India in that year, then also it shall qualify as resident in India. So firstly, if it's an Indian company, then we are not required to see where the POEM is situated. It shall always be resident in India. However, if it's not an Indian company, means a foreign company, then such company shall be deemed to be resident in India only if its POEM is situated in India. Now, what is POEM? Place of effective management. The place of effective management means a place where key management and commercial decisions that are necessary for the conduct of business of an entity as a whole are in substance made. Right? So, for determining where the POEM is situated, we have to see key management and commercial decisions. We are not talking about the routine decisions. The key management commercial decisions which are necessary for the conduct of business of the entire entity, of the entity as a whole, and are in substance made. Right? The POEM is a concept of substance and not a form. How we determine the POEM? We will see today only in 5 minutes. So, for registered status of a company, we have to ask whether the company is an Indian company. If answer is yes, then full stop, the company is a resident. But if answer is no, then we have to see whether the POEM of such company was in India in that year. If answer is yes, then the company is resident. If answer is no, then the company is non-resident. And remember, we have the concept of ROR and RNOR only in respect of individual and HUF. Such concept is not applicable in case of any other person. Now let's see how we determine the POEM of a person. POEM. So place of effective management, how to determine? So the simple rule is first determine whether the company is engaged in active business outside India. Whether the company is engaged in ABOI, active business outside India. If answer is yes, when the poem is situated at a place where majority of the board of meetings are held, right? Majority of board meetings. So if a company is engaged in active business outside India, then the poem of such company shall be situated at a place where its majority of the board of meetings are held. If the majority of such board of meetings are held outside India, then the poem shall be outside India. If the majority of poem board meetings are held in India, then the poem shall be in India and the company shall be resident. Okay. So it's not necessary, even if one or two board meetings are held in India, that will not make a difference if the majority of the meetings are held outside India and the company is engaged in active business outside India. Right. However, if a company is not engaged in active business outside India, then you have to see, you have to first identify the person who are taking key management and commercial decisions for the company. And then you have to see where such decisions are being taken, where these persons are located. So if just such person are located outside India, then the poem is outside India. If such person located in India, then poem is in India. So you understood how we go about it? So firstly, we have to see whether the company is engaged in active business outside India or not. If it is engaged in activity outside India, then we have to see where the majority of the board meetings have. If the majority of the board meetings were held outside India, then the poem of the company shall be treated as outside India. If the majority of the board meetings are held in India, then the poem shall be treated as in India. Okay? But if the company is not engaged in active business outside India, then we have to first identify the person who are actually taking the key management and commercial decision. Remember, the poem is a concept of a substance, not form. So we have to see who are actually taking the decision, not the one who are only approving the decision taken by somebody else. Okay. And once you identify the person who are taking the decision, then you have to see where such decisions are being taken. And the place where such decisions are being taken, place where these persons are located, shall be deemed to be the place where the poem of the company is situated. Clear? Let's come back to the notes. So it says, poem means a place of key management and commercial decision that are necessary for the conduct of business of an entity as a whole. So these decisions should impact the entity as a whole. So we are talking about the decision which impact the entity as a whole, and not the decision which impact only a segment or a branch or a section of the company. Right? So we are looking for the person who are taking the decision which impact the entity as a whole. Are in substance में. Now it says how to determine it. Where the companies engage in active business outside India, ABOI, the poem shall be presumed to be outside India if majority meetings of board of directors are held outside India. Clear? Okay. However, if it is established that board of directors are standing aside and not exercising their powers, which are being exercised by the Indian holding company or any other person resident in India, the poem shall be considered to be in India. So if it is proved on facts that board of director is not actually empowered to take the key commercial or management decision, or they are not actually taking the key management commercial decision, and such decisions are actually being taken by either the Indian holding company of the assessee or any other person who is located in India, who is resident in India, then the poem shall be treated as being in India. Clear? Now let's see how we compute the active business outside India. So it says that how we determine whether the company is engaged in active business outside India or not. So it says that a company is said to be engaged in active business outside India, ABOI, if the passive income of the company is not more than 50% of its total income, and less than 50% of total assets are situated in India, and less than 50% of total number of employees are situated in India or are resident in India, and payroll expense incurred on such employees is less than 50% of its total payroll expenditure. So if our entity satisfies all these four conditions, they are combined with the and. If a company satisfies all these four conditions, then shall be treated as engaged in active business outside India. And in such case, its poem shall be situated outside India if the majority of the bond meetings are held outside India. Okay? So what are these conditions? The passive income should be less than should be 50% or less of the total income. The asset in India should be less than the 50% of the total asset. The employees who are located in India or resident in India should be less than 50% of the total employees. And the payroll expenditure on these employees who are situated or resident in India should be less than 50% of total payroll expense. If any entity fulfills all these four conditions, then it shall be treated as an engaged in active business outside India. Let's understand the meaning of these terms. Total income means taxable income computed in accordance with the law of the country of incorporation, or as per books of account where the above computation is not required. The total income shall be computed as per the law of the country in which such foreign company is situated, is incorporated. And if such law does not require or does not have income tax, then the total income is the income as per the books of account. Okay. Now the passive income. Passive income is the aggregate of these two incomes, which is income from transaction where both purchase and sales, where both purchase and sales of good is from or to is associated enterprise. If even a purchase or a sale is to A, then it's not a passive income. But if goods are purchased from A and also sold to the A, then it's a passive income. And what are other passive income? Income by way of interest, capital gain, dividend, royalty, or rental income. These are also considered as passive income. Okay. But interest shall not be considered passive income in case companies engaged in business of banking or public financial institution. So the business of companies, the banking. So in such case, of course, the interest is not a passive income. Otherwise, passive income means that income from transaction if the goods are purchased from AE and also sold to the AE. And interest, capital gain, dividend, royalty, or rental income. These income are also considered as passive income. So if the passive income is up to 50% of the total income, then fine. But if it is more than 50%, then the company cannot be said to be engaged in active business outside India. Now, asset. The second condition was the asset in India should be less than 50% of the total asset. Now, how do you determine the value of the asset? It says in case of depreciable asset, the aggregate WDV at the beginning and end of the year in the country, the average of tax WDV at the beginning and end of the year in the country of incorporation. In case of any other asset, WDV as per the books of account. If the asset depreciable, then we have to take the average. If the asset not depreciable, then we'll take the book value. Okay. Employees. The third condition was the employees situated in India or resident in India should be less than the 50% of total employees. So it says that employees shall include. So it does not include only the formal employees, but it also includes the employees. It also includes the persons who, though, are not formally employed by the company, but they perform tasks similar to those performed by the employees of the company. Okay. So even if any person is not formally employee of the company, is a contractual person, then also it can be treated as employee if the task performed by such person is same as performed by the employees of the company. And average number of employees at the beginning and end of the year should be considered. Okay. Now, last condition was the payroll spends on the employee situated in India or resident in India should be less than 50% of the total payroll expenses. Now, how do you determine the payroll expense? Payroll expense means cost of salary, wages, bonus, and all other employee compensation, including related pension, social cost borne by the employer. So anything which the employee is bearing on behalf of for the purpose of the employee shall be part of the payroll expenses. Right? This data, the average data of previous year and 2 preceding year shall be taken into account for determining whether the company is engaged in active business outside India or not. The data of the current year and the preceding 2 years shall be considered. However, if the company was in existence for a shorter period, then the data of such shorter period shall be considered. Clear? Now, a issue comes if the accounting year of the company, of such foreign company, does not coincide with the financial year as we follow in India. Then in such case, what the provision say, with the accounting year for tax purpose in accordance with the laws of country of incorporation of the company is different from the previous year, then data for the accounting year that ends during the relevant previous year and two accounting year preceding year shall be considered. Clear? Now we discuss if the company is engaging in active business outside India, then we have to see where the majority of the board's meetings are held. If they are held outside India, the poem shall be outside India. However, if the company is not engaged in active business outside India for other companies. So now you understand how we compute, how we determine whether a company is engaged in active business outside India or not. So if the company is not engaged in active business outside India, poem shall be determined on the basis of location of persons taking key management commercial decisions. Then, as I told you, in such case, you have to first identify the persons who are taking key management commercial decisions, and then the location of such persons shall be treated as a place where the poem is situated. So, if such decisions are taken by the board of directors, then the poem shall be at the place where the board regularly meets and makes such decisions. However, if such decisions are taken by senior management or any other person, including shareholder, promoter, strategic or legal, or financial advisor, then the poem shall be at a place where senior manager or such other person make those decisions. If such decisions are taken by the executive committee, then the poem should be at a place where the members of the committee are based, where the such decisions are taken using the modern technology without physical presence of person taking the decision. The poem shall be at a place where the person taking the decision, majority of them usually reside. Physical location of board meeting may not be relevant. Lastly, decisions are taken through circular resolution or round robin voting. The poem shall be the place where parties involved in those decisions are located. So, the crux is that first you identify the person who are taking the decision, and then the place where such decisions are being taken shall be the place where the poem of the company is situated. Okay? However, even after all this, you cannot determine if the above factors do not lead to clear identification of poem. Then following secondary factors shall also be considered, which is place where main and substantial activity of the company is carried out and place where accounting records of company are kept. So these are only secondary factors which has to be come into light only if the above guidance does not give a clear identification of a place where the poem is situated. Okay. So by the word poem, we mean the place where key management commercial decisions are taken. Where the activities of the company are being carried on is not much relevant from poem perspective. Okay. We are looking for a place where the decisions are taken. Where decisions are implemented are not much relevant. Now see, the relaxation is provided for the company engaged in ABOI. And such company, even if take few key management commercial decisions in India, it shall be non-resident if majority of the board meetings are held outside India. In case of other company, means a company which is not engaged in active business outside India. Poem is a place where key management commercial decisions are taken. For this, firstly identify the person who are taking such decisions, and then poem shall be at a place where such decisions are taken. Okay? For the purpose of determination of poem, it is a substance which would be conclusive rather than the form. As I told you, poem is a concept of a substance and not form. So, who has the authority to take the decision is not of much relevance. Then, who actually takes the decisions? So, first we have to see who actually takes the decision. That's more important, and not the one who is supposed to be or who has authority to take the decision. Right? And the person who's actually taking the decision is where he's located, is the place where the poem is. Okay. It says merely because board of directors follow general objective principle of global policy of the group laid down by the parent entity, which may be in the field of payroll, accounting, human resource, IT, and network and supply chain, and routine banking operation, and are not being specific to any entity or group entities per se, would not constitute a case of board of director of company standing aside. So it says that it may happen that the board of director are following general policies of the group in respect of payroll, IT, banking, HR, etc. But following such general practices which are there for the entire group and not for a particular company. Following such practice does not mean that board of directors are not doing their job. Right? But at the same time, mere formal holding of board meeting at a place would by itself not be conclusive for determination of poem being located at that place. If the key reason by the directors are in fact being taken in a place other than the place where the formal meetings are held. So though formal meetings are held somewhere, but at such meetings, key reasons are not taken, they are taken at some other place. Then such other place would be relevant for the poem. Okay, clear? As an example, this may be the case where the board meetings are held in the location distinct from the place where head office of the company is located, or such location is unconnected with the place where predominant activity of the company is being carried out. Okay? So location of head office plays a very important role in determining the place where the poem is situated. So head office of a company would be a place where company's senior management and their direct support staff are located. Or if they are located at more than one place, the place where they are primarily or predominantly located. A company's head office is not necessarily the same as place where the majority of the employees work, or where both typically meets. Okay. The location of company's head office will be very important factor in determination of a company's place of effective management, because it often represents the place where key commercial decisions are made. The following point need to be considered for determining the location of head office of the company. If the company's senior management, their support staff are based in a single location, and that location is held out to the public as company's principal place of business or headquarters, then that location is the place where the head office of the company is situated. If the company is more decentralized, where various members of senior management may operate from time to time to office located in various countries, the company's head office would be the location where these senior managers are primarily or predominantly based, or are normally returned to following travel to other locations, or meet when formulating or deciding key strategy and policy for the company as a whole. Members of senior management may operate from different locations on more or less permanent basis, and members may participate in various meetings via telephone or video conferencing rather than by being physically present at meeting in a particular location. So with the growth of IT, this is possible. Now, in such situation, the head office would normally be a location, if any, where the highest level of management, for example, management director or finance director, and the direct support staff are located. In situation where senior management is so decentralized that it is not possible to determine the company's head office with a reasonable degree of certainty, the location of company's head office would not be of much relevance in determining company's place of effective management. Okay? The delegation of authority by board of directors may either be de jure, that is by means of formal resolution, or de facto, based upon actual and the executive committee. Senior management aspect of a company means a person who are generally responsible for developing and formulating key strategies and policies for the company, and for ensuring or overseeing the execution and implementation of those strategies on a regular and ongoing basis. Where designation may vary, these persons may include MD or CEO, finance director or CFO, COO, Chief Operating Officer, the heads of various division or department, like Chief Information or Technology Officer, Director for Sales or Marketing. A decision to open a major new manufacturing facility or to discontinue a major product line would, by example, would be the example of key commercial decision affecting the company business as a whole. So, by the word key management commercial decision, we mean the decision where, like, to stop a manufacturing facility or to start a new manufacturing facility. By contrast, decision by the plant manager appointed by senior management to run that facility concerning repairs and maintenance, the implementation of company-wide quality controls and human resources policies would be examples of routine operational decisions, and they are not the key management commercial decisions. In certain situations, it may happen that person responsible for operational decision, the same person who is also responsible for the key management commercial decision. In such case, it will be necessary to distinguish the two types of decision and thereafter access the location where key management commercial decisions are actually being taken. Clear? The place where management decisions are taken would be more important than the place where the decisions are implemented. So for poem, we are more concerned about the place where decisions are actually being taken and not the place where such decisions are actually being implemented. That is where the activities of the company are being carried out. Any determination of the poem will depend upon the facts and circumstances of a given case, a factual question. It may be noted that an entity may have more than one place of management, but it can have only one place of effective management at any point of time. So a company may have more than a place of a management, but place of effective management shall only be one. The above principles are not to be seen with reference to any particular movement in time. Rather, activities performed over a period of time during the previous year need to be considered. So we are not taking the snapshot approach. In other words, a snapshot approach is not to be adopted. The decision made by the shareholder on matters which are reserved for shareholder decision under the company laws are not relevant for determining where the poem is situated. Such decision may include sale of all or substantially all of the company's assets, the dissolution, liquidation, or deregistration of the company, the modification of rights attached to various classes of shareholders, or issue of new class of shares. So if shareholder are taking these decisions, then these reasons are not the reason which we are referring to in the case of poem. These are actually taken by shareholder and has no relevance to determine where the poem is situated. In the poem, we are actually looking for decision, key management commercial decision, which affect the entity as a whole. And such decisions are where in substance being made. Okay. These decisions typically affect the existence of the company or the rights of shareholder as such, rather than the conduct of the company's business from a management or commercial perspective, and are therefore generally not relevant for determination of company's poem. Right? However, shareholders' involvement can, in certain situations, turn into that of effective management. This may happen through a formal arrangement by way of shareholder agreement, or may also happen by way of actual conduct. As an example, the shareholder limit the authority of board of directors and senior managers, and thereby remove the company's real authority to make reason, then the shareholder guidance transforms into aspiration, and such undue influence may result in effective management being exercised by the shareholder. So if shareholder restricted the powers of board or senior management, and they are actually taking the decision for the conduct of company, the decision being taken by them is the key management commercial decision, then such place where such decisions are taken by these shareholders shall be the place where the poem is situated. Whether shareholder involvement is crossing the line to that of effective management is one of a fact and has to be dependent on case-to-case basis. Now, the following factor is not relevant for determination of poem. The fact that foreign company is completely owned by the Indian company, not relevant. The fact that there exists a permanent establishment PE of foreign company in India, not relevant. P is a place where the business is being carrying on. And we are looking at a place where decisions are being taken. Right? The fact that one or some of the directors of foreign company reside in India, not relevant. The fact of local management being situated in India in respect of activities carried out by foreign company in India, not relevant. The existence of India existence in India of support function that are preparatory and auxiliary. So we are looking for the place where key management commission is undertaken, not a place where actually the activities of the foreign company are being carried out. Even if the activities are being carried out in India, such activity will not make the foreign company poem in India. Okay. Now it says if it is determined, sorry, if it is determined that during the previous year the poem is in India and also outside India, then poem shall be presumed to be in India if it has been mainly or predominantly in India. Okay. The AO shall, before initiating any proceeding for holding a company incorporated outside India, on the basis of its poem being resident in India, seeks prior approval of Commissioner of Income Tax. The AO cannot himself assess a company as resident in India on the basis of poem. He has to take the approval of CIT or a collegium of CITs. This all what we have discussed about the poem is written in a guidelines issued by the CBDT, and the such guidelines shall not apply to a company having turnover of 50 crore or less in a financial year. These guidelines apply only to a company whose turnover is more than 50 crore. In case the AO proposes to hold a company incorporated outside India on the basis of its poem as resident in India, then any such funding shall be given by the AO after seeking a prior approval of collegium of 3 members consisting of Commissioner of Income Tax, and such collegium shall be constituted by Chief Commissioner of Income Tax. Now we'll see the provision if the company, the foreign company, at first year become a resident in India on account of poem. So if it's the first year of the company in which it is held to be resident in India on account of poem, then how the income of such company shall be computed? Such company will become resident company and global income shall be taxable. In a case where foreign company is said to have poem in India, for the first time, the provision of the Act shall apply with the following modifications. Okay. Now we have to see whether the foreign company assessed to tax in foreign jurisdiction or not. If it is assessed to tax, then the opening WDV of depreciable asset. We will require opening WDV because we have to give the depreciation for this year in India. Then opening WDV shall be the asset shall be computed as under. Where tax law require computation of depreciation, opening WDV shall be a tax WDV as on first day of the previous year. In other cases, if there is no depreciation in the tax loss or there is no tax on such company, WDV which would have been as on first day of the previous year, had depreciation was actually allowed as per the provisions of law of that country. However, the foreign company is not assessed to income tax in the foreign country, then WDV or depreciable asset as per books of account as on first day of the previous year shall be considered as WDV for income tax purposes in India. Opening WDV. Brought forward losses. It says brought forward loss and unabsorbed depreciation as per tax record shall be determined year-wise as on first day of the previous year. But if company is not assessed to income tax, then brought forward loss and unabsorbed depreciation as a books of account prepared in accordance with the laws of such country shall be determined year-wise as on first day of the previous year. Tax treaty benefits. The foreign company shall be entitled to relief or deduction of taxes paid in accordance with provision section 90 or 91 of the Act. Okay. Now it says, see, there are a lot of provisions which are applicable to resident or non-resident or to foreign company. Now it says where more than one provision applied to foreign company as resident as well as foreign company. The provision applicable to him as foreign company shall apply. Compliance to those provisions as applicable to foreign company prior to becoming resident shall be considered sufficient compliance to the said provisions. Section 195(2) shall apply in such manner as to include payment to foreign company. Clear? Now the question comes, if the accounting year followed by the foreign country for this foreign company is different from the financial year. It said if accounting year does not end on 31st March, the foreign company shall prepare its annual account for the period starting from the date on which the accounting year immediately following the accounting year which ended before first day of the previous year in which the company become resident begins up to 31st March of the year immediately preceding the previous year, and of 12 months beginning from 1st April and on 31st March till the year the foreign company remains resident in India on account of its point. Okay. It says the brought forward loss and unabsorbed depreciation as arrived above shall be allowed to be set off and carried forward in accordance with the provisions of this act for the remaining period calculated from the year in which they occur for the first time, taking that year as the first year. So you know the benefit of set off is allowed for 8 years. But that 8 year has to be counted from the first year when such loss was incurred by the company in foreign country. For the purpose of carry forward a loss and unabsorbed depreciation, where the accounting year of the foreign company does not end on 31st March, and the period referred to in para A above is less than 6 months, it shall be included in the accounting year which ended before the previous year. So if the previous year of the accounting of the company, as determined above, it falls short of 6 months, then such period shall be clubbed with the immediately preceding accounting year. How is such period referred above is equal to more than 6 months, then period shall be treated as separate accounting year. In above case, loss and unabsorbed depreciation as per tax records and books of account, as the case may be the foreign company, shall be allocated on a proportionate basis. We see through an example. The exception, modification, adaptation referred above shall not apply in respect of income which would have been charged in India, even if the foreign company had not become Indian resident. So, if any income was taxable in India, even when the foreign company was not resident in India, even when had the foreign company not been resident in India, then such income shall continue to be taxable in India, and these above provisions shall not apply to such income. Meaning, if there is brought forward losses, then such losses cannot be set off against the income which would have been taxable had the foreign company not been resident in India. So, if the foreign company is having any royalty FTS income, which was taxable even without being resident, that such income shall continue to be taxable, and any brought forward loss cannot be set off against such income. Any transaction of foreign company with any other person shall not be altered only on the ground that foreign company has become Indian resident. It says, in case where the brought forward loss and unabsorbed depreciation originally adopted in India are revised or modified in the foreign jurisdiction due to any action of the tax or legal authority there, the amount of the loss and unabsorbed depreciation shall be revised or modified accordingly in India as well. If unabsorbed business loss occurred in the hands of foreign company in AY 23-24, and such loss has not been set off subsequently, and the foreign country's poem was found to be in India in the assessment year 26-27, then such business loss shall be available for carry forward only for the remaining period of 8 years commencing from AY 23-24. The brought forward loss and unabsorbed depreciation will not be allowed to be set off against income of the foreign company, which would have been subject to tax in India even its capacity as non-resident, even if poem was not there. So if the foreign company was accessible in India even as a non-resident, then any profit losses shall not be set off against such income. According to the brought forward loss or another depreciation can be set off only against the income of foreign company which became chargeable to tax in India only by virtue of foreign company becoming resident in India on account of its poem. Example, where royalty income earned by foreign company subject to tax in India in its capacity as a non-resident, since the know-how is utilized in India, and the foreign company is also treated as resident in India on account of its poem in India, then brought forward loss or another depreciation cannot be permitted to be set off against such royalty income. Clear? Now, let's see how the accounting year is computed. For example, foreign company is following accounting year as of 1st Jan to 31st December. Now, foreign company become resident in previous year 25-26 on account of poem in India. Now, foreign company shall prepare its P&L account and balance sheet as under. From 1/1/25 to 31st March 25. From 1st April 25 to 31st March 26 and so on. However, if the accounting year followed by the foreign company is 1st July to 30th June, then foreign company shall prepare P&L account as 1st July to 31st March and from 1st April to 31st March, so on. Assuming the foreign company follows the calendar year. The company became resident in 31st March 2026. Now, accounting year of the company, that is 31st March 2026, shall be 31st March 2025, shall be increased by 3 months. And the accounting year company shall become 1/1/24 to 31st March 25. And according to the laws and other depreciation shall be proportionated. Now see, the withholding tax obligation on payment for work contract by resident in India to such foreign company deemed to be resident in India on account of POEM shall be governed by the provision of Section 195 as against 194C. Section 195 being specific to foreign companies shall prevail over 194C. So clear? The rate of income tax as applicable to foreign company, 35%, shall continue to apply even if the company become resident on account of its POEM. Where shares of foreign company are deemed to be resident, where the shares of a foreign company deemed to be resident in India on account of POEM held by a non-resident entity are transferred outside India, then such sale will not be taxable in the hands of non-resident seller merely because such company become resident on account of its POEM. I would say in case of conflict between the provision applicable to foreign company as resident and provision applicable to it as foreign company, the latter shall generally prevail. Therefore, the rate of tax in case of foreign company shall remain the same, that is, the rate of income tax applicable to foreign company, even though the residency status of foreign company changes from NR to R. The provision specifically applicable to a foreign company shall continue to apply to it. Non-resident persons shall not apply to it, and the provision specifically applicable to residents shall apply to it. Now, see what all reasons are relevant to determine the POEM. The reason to enter a new country, reason to close a major division, reason to approve annual budget, pricing policy for all the markets, funding structure, appointment or removal of a CEO. So the person or the authority or the committee taking this decision is relevant for determining the POEM of such company. Okay. Decisions which are not relevant for POEM: hiring factory workers, routine banking transaction, processing payroll, following group HRIT policy or maintenance of a plant. Right? So these are routine operational reasons which does not determine the POEM. Let's quickly see. The POEM is a substance over form. The concept of substance over form. POEM means where the brain of the company actually functions. Tax follows real power, not the paperwork. Why POEM exists? To prevent company from avoiding Indian tax by incorporating abroad while being controlled from India. So, POEM means key decision, which is management and commercial for business as a whole, are taken in substance. Who decides? Go, stop, or change direction. That place is POEM. Key management decision means market entry or exit, capital structure, pricing policy, appointment of CEO, and annual budgets. Routine decisions which are not relevant for POEM are payroll, accounting, HR, or factory operations. Delegation of execution allowed, but delegation of thinking not allowed. So if there is delegation of thinking, delegation of decision, then the authority who is actually taking the decision shall be the authority relevant for POEM. Board standing aside, core idea. Board exists on paper, real decisions are taken elsewhere. Foreign board meetings are held, but Indian promoter approve contracts and budget. Then POEM is in India. active business outside India. If there is active business outside India, then and the majority of board meetings are held abroad, then poem is outside India. Exception is board is standing aside, then the presumption break and poem shall be in India. Reasons are taken by Indian holding company or person Indian resident in India. Shareholder are generally not the person who are relevant for poem. The board of director and the senior management is the person which is relevant for poem. Operational person is also not relevant for poem. HO test, where senior management usually work, meets and return to strong poem indicator. However, if the decision are taken over a video call, then poem follows residence of decision maker. These things are not relevant where the foreign company is incorporated. If it's held by the Indian holding company, it has a P in India routine, Indian operations. Foreign subsidiary pricing strategy decided in India. OM India risk. Risk and strategy decided abroad. Indian office only scope. So poem is outside India. First, identify the decision maker, then identify the decision, and then identify the location where the decisions are being taken. So that location shall be the place where the poem is situated. The poem follows power, not paperwork. Okay. You must have understood the poem in a great detail. Now we are moving to scope of total income, right? So, in case of ROR, the global income is taxable. In case of NR, on the income received in India or deemed to receive in India or accrue in India, deemed to accrue in India, taxable. In case of RNOR, similar to NR, but one more income, which is accruing arising outside India, but from a business control from or a profession set up in India, right? A benefit is given to non-resident seafarer if they're rendering service in India, but they receive their salary in NRE Indian bank account. Then only for the purpose that the salary received in India, the such salary will not be taxable if it is received in NRE Indian bank account. Then income deemed to receive in India, Section 7. Any contribution excess of 12% of the salary to RPF or interest carried in excess of 9.5% shall be deemed to be received. Contribution by central government or any other employee in previous year under a pension scheme referred to 80CCD. Amount transfer from URPF to RPF being the employer contribution interest thereon. These amounts shall be treated as being resident, being received in India. Now important, Section 9. Income deemed to accrue or rise in India. So whatever income is listed in Section 9 shall be deemed to accrue or rise in India, and such income shall be taxable in the hands of NR. Because in case of NR, the income accruing or rising or deemed to accrue or rise is taxable in India. So if the income is deemed to be accruing or rising in India, then such income shall be taxable in the hands of NR also. Okay. Firstly, all income accruing or rising, whether directly or indirectly, through or from any business connection in India, shall be deemed to accrue or rise in India. So if the NR has a business connection in India, then any income rising from such business connection shall be deemed to accrue or rise in India. However, in case of business of which all the operations are not carried out in India, the income attributed to operation carried out in India shall be deemed to accrue or rise in India. So if all the operations are not carried out in India, then only such income which is attributable to operation carried out in India shall be deemed to accrue or rise in India. Right. By the word business connection, we use to mean the actual physical presence of a foreign entity in India. However, this physical presence, concept of this physical presence gets diluted year by year. Now its act says that business connection shall include any business activity carried out through a person who acting on behalf of non-resident. So even if the non-resident is not actually himself physically present in India, but if it has an agent in India, an activity of such agent would also be sufficient to constitute the business connection of NR in India. So what are these activities of the agent? If the agent has and habitually exercises in India an authority to conclude contract on behalf of NR, or habitually concludes contract, or habitually plays a principal role leading to conclusion of contract by that NR. So either he is concluding the contract, or He is playing a principal role leading to conclusion of the contract by the NR. And the contracts are in the name of the NR, for the transfer of ownership or of the granting of right to use property owned by that NR or that NR has right to use, or for the provisional service by that NR. If the agent has no such authority to conclude contract, but he habitually maintains in India the stock of goods or merchandise from which he regularly delivers goods or merchandise on behalf of the non-resident, or the agent habitually secures order in India, so mainly or wholly for the non-resident, or for that non-resident and other non-resident controlled by and subject to same common control as that of non-resident. Business connection shall not include any business activity carried out through a broker, general commission agent, or any other agent having an independent status, if such person acting in the ordinary course of business. So, the agent referred above shall not include independent agent. If the activity as referred above of concluding contract or playing a principal role in conclusion of contract or maintaining stock of the foreign NR or securing order on for the mainly or wholly for the NR, then if such activity are performed by independent agent, then such activity will not constitute the PE of NR, business connection of NR. However, if such activities are done by the dependent agent, that will constitute the business connection. Right. Now it says where such person, where the agent works mainly or wholly on behalf of non-resident or on behalf of such principal and other non-resident controlled by the principal or having a controlling interest in the principal or subject to same common control as the principal, he shall not be deemed to be a broker, general commission agent of independent status. So if he's working wholly or mainly for a non-resident or such non-resident, and if he's working only for a non-resident, then he's a dependent agent, or he's working for this non-resident and also any other non-resident, but such other non-resident is controlled by the first non-resident, or such other non-resident is controlling the first non-resident, or such non-resident and the first non-resident are in common control, then the agent shall be deemed to be a dependent agent. Further, the threshold for constituting business connection is again diluted with the introduction of the term of the concept of significant economic presence, SEP. Where it says significant economic presence of a non-resident in India shall also constitute business connection in India, and SCP for this purpose shall mean transaction in respect of any goods, service, or property carried out by a non-resident in India, including provision for download of data or software in India, if the aggregate of the payment arising from such transaction during the previous year exceed 2 crore, or systematic content soliciting of business activity or engaging in interaction with such number of users as may prescribe 3 lakh in India through digital means. So in either of these cases, A or B, the SCP is constituted and SCP is treated as business connection. The transactional activity shall constitute SCP in India whether or not the agreement for such transaction activity is entered in India, or whether or not the non-resident has a residence or place of business in India, or whether or not the non-resident renders services in India. Further, where business connection is established by reason of significant economic presence in India, only so much of the profits or income as is attributable to transaction referred above shall be deemed to accrue rise in India. Following income shall be deemed to be the income attributable to operation carried out in India to be determined in accordance with the rules made by CBDT. So what are these transactions? Income from advertisement which target a customer who resides in India or customer who access such advertisement through IP, Internet Protocol address located in India. Or transaction of sale of data collected from a person residing in India or from a person who uses Internet Protocol address, IP address located in India. And sale of goods or service using such data. The following income shall be deemed to be operation carried out in India. Right? Now business connection. Why business connection exists? Foreigner earning income from India without any presence. India wanted his share of tax. Link between income and India required. Business connection should be a real and intimate relation. Substance prevails over form. Example, foreign companies sell goods in India, operate partly in India, or income attributable to India, taxable in India. So business connection actually when there's a business in India and not business with India. If the foreign company is doing business with India, then it does not have a business connection in India. If a foreign company doing business in India, then it's a business connection in India. Classic example of business connection. Branch or office in India, factory or workshop or sales outlet. This was the historically business connection concept. Now agency business connection. Why it was launched? Because a foreigner may not come to India personally, but may still do business in India through another person. That other person is called agent, right? So the law says if a non-resident carries on business in India through an agent, then the non-resident is treated as having a business connection in India. So earlier, physical presence of non-resident were required, but now it says even if the business is being carried out in India through agent, then non-resident shall be deemed to have a business connection in India. Why agency concept? Tax law initially assumed business is done personally or through office, branch, or factory. But in reality, business often operates through representatives, especially foreign companies. Hence, the law evolved to say if someone in India habitually acts for you, it is as good as you being here. Right? So, by this, you will understand the concept of BC, business connection. So, Mr. John lives in UK. He sells industrial machinery in India. He never comes in India. But Mr. Raj in Mumbai find customer, negotiate price, finalize the contract, and collects the payment. So can Mr. John say that I have no connection with India? Answer is no. Mr. Raj is effectively John's Indian business arm. This business connection through an agent. So Mr. Raj is only representing the Mr. John only. Who is agent? An agent is a person in India who acts on behalf of the non-resident and helps in earn income in India. Law identifies three types of agent-based business connection. So, category one, if the agent who habitually concludes contract. So, if there's a person in India who habitually concludes contract or habitually negotiate and finalize the contract on behalf of non-resident, then his activity will constitute the business connection. Or if an agent who maintains stock of good for non-resident and deliver good to customer in India on behalf of non-resident, then there is a business connection. If your goods are waiting in India to be sold, your business already in India. Or if there's an agent who habitually secures orders, who regularly finds customers, secures order mainly only for the non-resident, or as I told you, for another non-resident who is controlling this first non-resident, who is under the control of first non-resident, or both of these non-residents are under the same common control. Agent who habitually secures order. Only dependent agent creates business connection. An agent dependent if it works mainly or exclusively for one non-resident. Independent agent does not create business connection. An agent is independent if it works for multiple non-residents. exclusive broker like dependent agent, stock broker, independent agent. So business connection says that you may sit abroad, but if someone in India is regularly doing your business work, the law will treat you as doing business in India. Now what happens is that they change the drafting and they said that agent is not doing concluding the contract, but agent was actually practically doing everything, and the Anna was only signing the contract as a formality. So earlier the business connection was constituted if agent habitually conclude contract, but now after the amendment, business connection exists if agent habitually plays the principal role leading to conclusion of the contract, even if contracts are formally concluded abroad. Principal role means if the Indian person does all the real commercial work and the foreign company only rubber stamp it, then the Indian person is playing the principal role. We are looking for habitual activity, not one-off activity. For business connection, do not look for the person who actually signs the paper. Look at the person who actually runs the deal, right? Now, the concept is again diluted and say that SCP shall be treated as business connection. So earlier, non-resident taxable if they had a business connection in India, and meaning if they either have an office in India, employees or agents in India, factory branch or physical presence in India. In the absence of business connection, there is no tax. Now take it for example. A foreign company runs an online advertisement platform. Indian businesses pay crores to show ad to Indian customers. Entire system is server outside India, contract signed outside India, payment received outside India. So earlier, it did not constitute business connection, yet there was Indian customer, Indian market, Indian revenue. So this was very economically unfair to India. See one more example. There is a foreign platform gaming company. It has millions of Indian users and users paying subscription fee. So in all these cases, tax law was designed for factories and offices, not for digital business. But now the way the business are being done have changed. So therefore, SCP, significant economic presence, was introduced. Now physical presence is no longer necessary to earn money. Digital economy allows remote selling, remote service, and remote data collection. So India expanded the meaning of business connection to include economic presence without physical presence. So there's an economic presence, even if there's no physical presence, still business connection can exist. If a foreign company earns substantial money from India or has deep user engagement in India, India will treat it as having business connection, even if it never steps into India. So clear? So if a non-resident enters into a transaction with Indian person involving goods, service, property, digital service, and aggregate payment exceed 2 crore, then significant economic presence exists and therefore business connection exists. But SCP can also exist even if there's no money, but there's a user interaction. Even if payments are low or indirect, SCP is constituted if non-residents systematically and continuously solicit business or interact with users in India through digital means. And number of Indian users exceeds 3 lakh. So we are talking about social media platforms. SCP also does not tax the entire global income. Only income attributable to Indian operations or users or transaction is taxable. Attribution principle here applies. So earlier, no office in India, no tax. But now, if you make serious money from India or seriously use Indian user, then India will tax you. Clear? So this was the important concept of business connection. A very small thing left. Some of the activity are kept outside the purview of business connection. One, if income from operation which are confined to purchase of goods in India for the purpose of export, it is kept out of the business connection. Or income from activity which are confined to collection of news and views in India for transmission outside India, or income from operation which are confined to shooting of cinematographic film in India, where the non-resident being individuals also not a citizen of India, or where the non-resident is a firm and it does not have any partner who is a citizen or resident in India, where the non-resident is a company and does not have any shareholder who is a citizen or resident in India. And the last activity is income from activities which are confined to display of uncut and unassorted diamond in a special zone notified by the central government if such income accrued to foreign company engaged in the business of mining. So first three exemption given to all entities, whether individual HUF, AOP, UA, whatever, any NR entity. But the fourth activity is given only to a foreign company. And that too, such company should engage in the business of mining. Right? The concept of business connection is a domestic law concept, the concept of Income Tax Act. Under the tax treaty, there is an equivalent concept of permanent establishment. So it says if there is a double taxation avoidance agreement between the India and the country of NR, then if there is a PE in India as per the terms of such DTAA, then income is taxable in India as per DTAA. If there is no PE, then income is not taxable in India as per DTAA. Then in such case, even if the NR has a business connection in India, still income is not taxable because Section 90 says that an SSC has an option to opt for the treaty provision or the provision of the Act, whichever is more beneficial to it. Even if there is a business connection, but there is no PE, then Section 911 shall not apply, since DTAA provides that income is not taxable in India in the absence of PE. As per Section 90, DTAA or the Act, whichever is beneficial to SSC, shall apply. Yeah? If there is no DTAA, then there is no DTAA, then there is no concept of PE, permanent establishment. Then we have to go back to the business connection. If business connection is there, income is taxable. If business connection is not there, income is not taxable. Simple. The concept of PE. It says, as per Article 5(1) of the DTAA, it provides that PE means a fixed place of business through which the business of enterprise wholly or partly carried on. So PE means a place of business through which the business of the enterprise is carried on. As per DTAA, income of non-resident taxable in India only if it has a PE in India, except in case of income from royalty, FTS, or interest and dividend. However, as per the Section 911, income of non-resident is taxable in India if it has a business connection in India. The term business connection is very wide than the word PE used in DTAA. And as per Section 90, DTAA or Income Tax Act, whichever is more beneficial to SSC, shall apply. So if there is a DTAA and the SSC does not constitute PE, then his income is not taxable even if it constitutes business connection. Because as per Section 90, he can opt for the provision of DTAA if the same are more beneficial to him. Right? Now, another list of income under Section 911. All income accrued arising, whether directly or indirectly, through from asset or property in India, through from any asset or source of income in India, or through the transfer of capital assets situated in India, shall be deemed to accrue as India. So if the asset, property, or source of income is in India, or the capital asset situated in India, then income derived from such assets shall be deemed to accrue or rise in India. Income from salaries. Income which fall under that salary shall be deemed to accrue or rise in India if it is earned in India. Right? For the purpose of this section, income for service rendered in India and the rest period or leave period which is preceded or succeeded by services rendered in India and form part of service contract of employment shall be regarded as income earned in India. Income chargeable under salaries payable by the government to a Indian citizen even for service rendered outside India, shall be deemed to accrue rise in India. So, what are deeming section? So, even if services are rendered outside India, but the salaries are paid by the government and to Indian citizen, then even if services are rendered outside India, the salary shall be deemed to accrue or arise in India. Now we break for a small break and then we'll discuss the source based income. Okay. So let's meet on 7:37. Okay. Okay. So now we will discuss some of the income which are taxable on gross basis, on source based program, and also the gross basis. By the mean source base, I mean that they are taxable even if the non-resident does not have a PE in India. Okay. So first such income is dividend income. If the non-resident is driving a dividend income from India, then how and when such income can be taxable? So Section 9 says dividend paid by an Indian company outside India is deemed to accrue rise in India. So if the dividend is paid by an Indian company, it shall be deemed to accrue or rise in India and taxable in the hands of non-resident. Rate of tax applicable on dividend received by NR of foreign company, Section 105A. So dividend income earned by NR of foreign company taxable at the rate of 20%. Dividend received from a unit in IFSC, referred to in Section 80 LA, is taxed 10%. So generally, the dividend taxable at the rate of 20% as provided in Section 115A. Right? No expenses shall be allowed at deduction against the above income. The deduction of Chapter 6A is allowed against the above income. So no deduction Chapter 6A or not any expenses allowed against the above income, above dividend income. But and now the foreign income deriving only dividend income from India, and if tax has been deducted on such dividend income at the rate of 20%, then as discussed above, then the and now foreign company is not required to furnish return of income in India. Right. So if the only income from India, taxable in India in the hands of NR or foreign company is the dividend, and the payer has already deducted tax as per Section 105A, then the NR or the foreign company is exempted from the requirement of filing return of income in India. So clear? So 105A said no expense shall be allowed, nor and deduction under Chapter 6A shall be allowed. But there is no restriction to set off current year or earlier year losses against the dividend income referred to 105A. And basic exemption of 2,50,000 also not available to NR individual against income referred to 105A. Second such income is which is taxable even without the PE or business connection is interest. So the law says interest income by way of interest is deemed to accrue rise in India if the same is payable by the government. If the borrower, if the payer is the government, then the interest income shall be deemed to accrue rise in India. However, if the payer is a person who is resident in India, then also it shall be deemed to accrue rise in India, but except when such interest is payable in respect of debt borrowed or money debt incurred, money borrowed and used for the purpose of business profession carried on by such person outside India or for the purpose of earning any income from any source outside India. Or whether interest is payable by any person in India, non-resident, and it shall be deemed to accrue rise in India where the interest is payable in respect of debt incurred or money borrowed and used for the purpose of business profession carried on by such person in India. In a nutshell, if the payer is a government, then such interest shall always be deemed to accrue rise in India. If the payer is any person other than government, then such interest shall be deemed to accrue rise in India only if the money borrowed has been used for business profession in India, or in case of resident earning any income from any source in India. Now, it says interest payable by a PE in India of a foreign bank to such bank. So there is a PE of a foreign bank in India, and such PE is paying interest to such bank or to any other branch of such bank outside India. To such bank outside India, shall then it shall be deemed to accrue rise in India in the hands of recipient. Right? Now, taxability 105 tax rate. So interest income earned by any foreign company is taxable as under. interest received from government or Indian concern on money borrowed by it in foreign currency, 20%. Interest from infrastructure debt fund, referred to in section 1047, 5%. Interest referred to in section 194 LC or LBA, 5%. No expense shall be allowed a deduction against the above income. No deduction chapter 6 is allowed against the above income, similar to dividend. However, deduction referred to it, ATL shall be allowed. And if the NR of the foreign company has only the interest income as referred above, and tax has been deducted in accordance with section 105A, then the NR of foreign company is exempted from filing return of income. So these all three provisions are similar to dividend. It says, what is interest? Interest means interest payable in any manner in respect of money borrowed or debt incurred, including a deposit, claim, or other similar right or obligation, and includes any service fee or other charge in respect of money borrowed or debt incurred in respect of any credit facility which has not been utilized. Clear? Interest on money borrowed by non-resident for any purpose other than business or profession will not be deemed to accrue or arise in India. If non-resident A borrows money from non-resident B and invests the same in shares of Indian company, the interest payable by A to B will not be deemed to accrue or arise in India. Interest received from government or Indian concern on money borrowed in foreign currency does not include interest on bank deposits. So there is no restriction on set-off of current year or earlier losses against income referred to 115A, as discussed in the case of dividend. Similarly, the basic consumption limit is not available to NR. Now, this is interesting. In case of non-resident being a person engaged in the business of banking, so we are talking about a foreign bank, any interest payable by the PE in India of such non-resident to the head office or any PE or any other part of such non-resident outside India, it shall be deemed to accrue as in India. So there is a foreign bank, it has a branch PE in India. Now such PE is paying interest to such bank or to any other branch outside India of such bank. Then the interest so paid shall be deemed to accrue or arise in India in the hands of recipient. Okay. Such interest shall be chargeable to tax in addition to any income attributable to PE in India. Further, P in India shall be deemed to be a person separate and independent of the non-resident person of which it is a P. So P shall be treated separate from its principal. And the provision of the Act relating to computation of total income, determination of tax, and collection recovery would apply accordingly. Also, P in India has to deduct tax at source on any interest payable to either the head office or any other branch or PE of the non-resident outside India. Non-deduction will result in disallowance of interest claimed as expenditure by the PE and may also attract levy of interest and penalty in accordance with relevant provisions of the Act. Clear? So it says that if there's a P in India of a foreign bank, then whatever interest the P is paying to the foreign bank or to any other branches, it shall be deemed to accrue as in India in the hands of recipient, and the P shall also be required to withhold tax on payment of such interest. Now, we are moving to the third category and the last category, royalty and FTS. So these income are also taxable even without a PE. So what is the principle when they are of accrual and arise? Section 916 in respect of royalty says, income by way of royalty is deemed to accrue or arise in India if the same is payable by the government or a person who is resident where royalty is payable in respect of any right, property, or information used or service utilized for the purpose of business or profession carried on by such resident in India, or for earning any income from any source in India, or where the royalty is payable by a person who is non-resident, where the royalty is payable in respect of right, property, or information used or service utilized for the purpose of business or profession carried on by such person in India for earning any income from any source in India. So similar to interest. if the right property information in respect of which royalty is payable. If such right property information is used in India, then the royalty for paid is taxable in India. It shall be deemed to accrue rise in India. Or if the royalty is paid by the government of India, then all cases deemed that to accrue rise in India. Right? Meaning of royalty. Royalty means consideration, including lump sum consideration, but excluding any consideration taxable under capital gain. For transfer of all or any rights, including granting of license, in respect of patent, invention, model, design, secret formula, process, trademark, or similar property. The imparting of any information concerning the working of these assets, working of or use of patent, invention, design, model, secret formula, process, trademark, or similar property. Or consideration for use of any patent, model, design, secret formula, process, trademark, or similar property. Or imparting of any information concerning technical, industrial, commercial, or scientific knowledge, experience, or skill. The use or right to use an industrial, commercial, scientific equipment, but not including the amount referred to in Section 44BB. The transfer of all or any right in respect of copyright, literary, artistic, scientific work, including film or videotape for use in connection with television, or tape for use in connection with radio broadcasting, or rendering of any service in connection with the activities referred above. Now, it says royalty also includes consideration for transfer of all or any right to use computer software, irrespective of the medium through which such right is transferred. Right. And royalty also include any consideration with respect to right property information, whether or not the possession or control of such right property information is with the payer, whether or not the right property information is used directly by the payer, or whether or not the location of such right property information is in India. And the expression process include transmission by satellite, including uplinking, amplification, conversion for downlinking of any signal, or transmission by cable, optic fiber, or any other similar technology, whether or not such process is secret. Now it says lump sum payment by a person who is resident for transfer of all or any rights in respect of computer software supplied by non-resident manufacturer along with the hardware, along with the computer, under any scheme approved by the government shall not be considered as royalty. Clear? So important for exam is that even consideration for use or rights to use computer software per se, not the copyright. The computer software per se is treated as a royalty. Computer software means any computer program recording any disk, tape, perforated media, or any other information storage device, and includes such program or any customized electronic data. Interest royalty FTS received by NI is deemed to accrue rise in India, whether or not the non-resident has a place of business, business connection in India, or non-resident has rendered service in India. So they shall be deemed to accrue rise in India, even if services are not rendered in India, but if the same are utilized in India. Like now, a Supreme Court decision in the case of EAC. What happens that the issue of whether the amount paid by resident Indian end user or distributor to non-resident computer software manufacturer or supplier as consideration for use or resale of computer software through end user license agreement EULA or distribution agreement be considered as a payment of royalty for use of copyright in computer software. This issue came before the Supreme Court in the case of Engineering Analysis Center of Excellence. The Apex Court observed that as per the definition given in explanation 2 to section 916 of the Act, royalty means consideration for, inter alia, the transfer of all or any rights, including granting of license, in respect of any copyright, literary, artistic, or scientific work. As per explanation 4 there too, such transfer of all or any right include transfer of all or any right for use or right to use a computer software, including granting of license. As per the meaning of the royalties as assigned in DTAA with Singapore, royalty means payment of any kind received as a consideration for use or right to use copyright of a literary, artistic, or scientific work. Neither the meaning of royalty in Indian DTS with other countries like Australia, Canada, France, Italy, USA, Netherlands, Sweden, Taiwan, Japan, China, etc. is also similar if not identical. This was observed by the Supreme Court. The Supreme Court said the definition of royalty under DTA does not include transfer of right to use computer software per se. So in the DTA, the royalty only means use the right to use copyright. Though under the Act, use the right to use computer software per se as royalty, but this position is not same in the DTAA. The scope of definition of royalty under the Act is wider as compared to definition of royalty under the India's DTAA with these countries. The apex court observed the following 4 category of cases in which distribution agreement and end user license agreement did not create any interest or right to such distributor or end user, which could amount to use or right to use copyright. So in these 4 cases, the payment shall not qualify as royalty under the DTAA. First case is where the software is purchased directly by the end user resident in India from a foreign non-resident supplier or manufacturer. So if the Indian resident is directly purchasing the software from a non-resident, or where the resident Indian company is acting as a distributor, purchases computer software from foreign non-resident supplier or manufacturer, and then resell the same to resident Indian end user. In this case also, there is no royalty taxability under DTAA. When the distributor happened to be a foreign non-resident vendor who, after purchasing software from a foreign, resell the same to resident Indian distributor or end user. And lastly, where computer software is affixed into the hardware and is sold as an integrated unit or equipment by foreign non-resident supplier to resident Indian distributor or end user. Therefore, in specified cases mentioned above, the apex court held that amount paid by resident Indian end user or distributor to non-resident computer software manufacturer or supplier as consideration for resale or use of computer software through end user license agreement or distributor agreement is not royalty. Consequently, the consideration paid to non-resident computer software manufacturer or supplier will not be chargeable to tax in India. Hence, no tax is required to be deducted under Section 195. It was held in the case of EAC by the Supreme Court. Now, the intention of introducing the source rules was to bring to tax interest, royalty, FTS by creating a legal fiction under Section 9. Even in cases where services are provided outside India, as long as they are utilized in India. The source rule therefore means that the situs of rendering of service is not relevant. It is situs of the payer and the situs of utilization of service which will determine the taxability of such service in India. Understood? Income of a non-resident shall be deemed to accrue arising in India under clause 5 interest, 6 royalty, or 7 FTS, and shall be included in total income of non-resident whether or not the non-resident has a residence or place of business or business connection in India, or whether or not the non-resident has entered service in India. Clear? Now see, Indian banks make use of server of foreigners for credit card transaction. For any credit transaction where a swipe is made, the swipe transaction is verified by a server of a foreigner which is located outside India. Indian banks make payment to this foreigner for all such swipe. Now the foreigner argues that his income from Indian bank is not taxable in India because possession of server is not with Indian bank, server is not used by Indian bank, the location of server is outside India. However, the Finance Act 2012 clarifies that payment made to foreigner shall be treated as royalty, even if the possession is not with the India, possession server is not within India, server is not used directly by the payer Indian bank, and the location of server is not in India, that is, it is outside India. Even then, the payments for made shall be treated as royalty. Indian TV channels make use of satellite of foreigners to transmit their program. Now, the payment made to foreigner for transmission of program by satellite is treated as royalty liable to TDS under Section 195. However, consideration for supply of software embedded in the hardware is not treated as royalty, since the software was loaded on the hardware and did not have any independent existence. The software is embedded in the system and there could not be any independent use of the software. The software merely facilitates the functioning of the equipment and is an integral part of the hardware. So it has loses its identity. Now it has merged with hardware. It's the hardware goods had actually been sold. Okay. Now we come to FTS section 917. Similar to royalty, the FTS deemed to accrue or arise in India, the same is payable by the government or a person who is resident, where the fees are payable in respect for service utilized in a business or profession carried on by such person in India or for earning any income from any source in India. Or where the same is payable by a non-resident, where the fees are payable in respect of services utilized in a business or profession carried on by such person in India or for earning any income from any source in India. As we discuss the meaning of royalty, now we discuss the meaning of FTS, fee for technical service. So it says fee for technical service means any consideration for rendering of managerial, technical, or consultancy services, including provision of service by technical, provision service of technical or other personnel, but does not include consideration for any construction, assembly, mining, or like project undertaken by the recipient, or consideration which will be the income of recipient under the head salary. Now we understand when the royalty and FTS shall be taxable when it is deemed to accrue rise in India. Right? We have understood the meaning of FTS and royalty. Now taxability of this income in the hands of NR or foreign company. In case of NR or foreign company has a PE in India, then Section 44DA applies. And Section 44DA says, where such non-resident foreign company has a PE in India or perform professional service from a fixed place of profession situated in India, and the right property or contract in respect of which royalty or FTS is paid is effectively connected with such PE or fixed place of profession. So, if the royalty or FTS is connected with the PE, permanent establishment of foreign company or non-resident in India, then Section 44DA applies. Then it says the income by way of royalty or FTS from government or Indian concern shall be computed under TGBP in accordance with the provisions of this act after allowing expense and tax bear at normal rate. Then if the royalty and FTS are effectively connected with the PE, then such royalty and FTS shall be taxable on net basis after allowing the expenditure. The provision of Section 44BV shall not apply in respect of income referred to in this section. The NR foreign company shall keep and maintain books of account as per Section 44AA and get the audit report on or before the due date of furnishing return of income under section, on or before the due date of furnishing tax audit report under Section 44AB. However, if the cases are not covered Section 44DA, meaning if the royalty and FTS are not effectively connected with P, that is, either the NR foreign company does not have a P in India, or even if it has a P, such royalty and FTS is not effectively connected with such P, then such royalty and FTS income shall not be taxable under Section 44DA on net basis, rather it shall be taxable under Section 115A on gross basis. What 115A says that income by way of royalty or FTS other than referred to in section 44DA. Received from government or Indian government shall be taxable at the rate of 20%. So there is a 20% rate under section 105 in respect of all income. Dividend, interest, royalty, FTS. Generally, there are some exceptions. Say for in case of IFSC, the tax rate on dividend is 10%. In case of interest, there is a rate of 5% also. Right? No expenses shall be allowed deduction against the above income. Deduction in chapter 6 shall be allowed against the above income. So this is difference. In case of interest and dividend, we saw that even deduction in chapter 6 is not allowed. But in case of royalty and FTS, the Act is allowing a deduction in chapter 6A. Though expenses are not allowed in neither in dividend, nor in interest, nor in royalty, nor in FTS. So all these four income under section 105A is taxable on gross basis. But in case of royalty and FTS, deduction in chapter 6A is allowed. This section is applicable if the income is received in pursuance of an agreement made with the government or approved by the central government. So either the royalty FTS is received under an agreement by the government or such agreement is approved by the government. However, the agreement is not approved. The approval is not required if the agreement relates to the matter included in the industrial policy for the time being forth of the government of India. Yeah. Similar to interest and dividend, the MR of foreign company having only the royalty or FTS income from India is not required to furnish return of income if tax on such royalty or FTS has been deducted in accordance with the provision of section 105A. So, under section 44DA, though it says that royalty and FTS shall be computed on net basis after allowing the expenses, but following expenses are not allowed even under section 44D. First is in respect of any expenditure allowance which is not wholly and exclusively incurred for the business of such PE, office place of profession in India, or in respect of amount, if any, paid otherwise than towards reimbursement of actual expenses by the PE to HO or to any of its other offices. Right? So the expense is not incurred wholly and exclusively for royalty or FTS, such expense shall not be allowed. Now we are moving to presumptive taxation for non-resident. Right? So, in respect of some of the specified business of non-resident, the Act allows them to pay the tax on presumptive basis. The first section is 44B. It's applicable to non-resident engaged in the shipping business. So it says, notwithstanding anything contains section 28 to 43A. So it overrules the PGBP Act. In case of non-resident carrying on shipping business, other than cruise ship referred to in 44 BBC, 7.5% of the following amount shall be deemed to be the PGBP. What is the amount? Amount received in or outside India for carriage of passenger, livestock, mail, or goods shipped at any port in India. So if the amount is received in respect of goods or passengers shipped in India, then whether such amount is received in India or outside India not relevant, or any amount received in India for carriage of passenger or goods shipped at any port outside India. The aggregate of this amount, this receipts, as 7.5% of these aggregates shall be deemed to be the profit and gains of NR from the shipping business. The amount of carriage includes amount received by way of demurrage charges or handling charges or any other amount of similar nature. Clear? So 44B says that it overrules the entire PGBP Act and it gives a presumptive rate of 7.5% in respect of shipping business of non-resident. This 7.5% shall be of the freight received whether in India or outside India, but in respect of passenger goods shipped from any port in India, or freight received in India in respect of passenger or goods shipped at any port outside India. Right? Now there is one more provision, section 172. This is also in respect of taxation of NR engaged in shipping business. It says, notwithstanding anything contained in the Act. So 44B overrules the PGBP head. 172 overrules the entire Act. In case of non-resident carrying on shipping business and deriving income from carriage of passenger, livestock, mail, or goods shipped at a port in India, 7.5% of the amount received on account of above carriage shall be deemed to be the income accruing in India in respect of such carriage. So there's another way of computing the income, 172. But 172 is applicable only in respect of receipts from passenger or goods shipped in India, shipped from any port in India. Though 44B used to apply on both, whether the passenger or goods are shipped in India or also in respect of freight received in India. But 172 only applies in respect of one, that is freight in respect of passenger or goods shipped from any port in India. What happened? What is the procedure of section 172? It says, master of the ship shall prepare and furnish a return of his income, referred to in this section, to assessing officer before departure of the ship from any port in India. So it's mandatory for a ship to first furnish a return. The master of the ship shall furnish a return before departing the ship from any port in India. However, the AO may allow that such return can be filed within 30 days of departure of the ship by a person authorized by the master of such ship. If AO is satisfied that it is not possible for the master of the ship to furnish the return before the departure, and the master of the ship has made prescribed arrangement, satisfactory arrangement for filing of return and payment of tax. Right? On receipt of return, so once the return is filed by the master or any other person authorized by him, on receipt of return, the AO shall determine the tax payable computed at the rate applicable to the foreign company, and such sum shall be payable by the master of the ship. Okay? The AO shall pass the above order within 9 months from the end of the financial year in which return is furnished by the master of the ship or person authorized by him, as the case may be. For the purpose of determining tax payable, AO may call for such accounts or document as may require. A port clearance certificate shall be issued by the custom officer only when he is satisfied that the tax payable under this section, under section 172, has been duly paid or that satisfactory arrangement have been made for the payment thereof. The assessee may, before the end of assessment year relevant to the previous year in which date of departure of ship from Indian port falls, claim that the assessment is made of his total income in accordance with other provisions of the Act. Other provisions of the Act means section 44B. In such case, any tax paid by assessee under this section shall be deemed to be an advance tax. Right? I explained to you. So in case of NR engaged in shipping business, whenever the ship departs from any port in India, the provision of section 172 comes into play. They're mandatory. What they say that? Section 172 says that before leaving the ship, the master of ship shall furnish a return of income. Right? And on the basis of such return of income, the AO shall make the assessment. Right? In the return of income, the master of ship show the receipt on account of passenger or good shipped from any port in India. And whatever the freight is there on account of such passenger or good, 7.5% of such freight shall be deemed to be the income of the ship in India. Right? And on this income, rate applicable to foreign companies shall be applied irrespective of the status of the ship owner. Even though ship is owned by the individual, Still under Section 172, the tax is paid at the rate applicable to the foreign company, right? But the assessee has an option to opt for the normal provision, that is 44B, before the end of the relevant assessment year. And once such an option is exercised, the tax for paid under Section 172 shall be deemed to be the advance tax. Right? So this is the method when a ship leaves India. Right? See, assessee has the option to choose between 44B and 172. In case assessee opts for 44B instead of 172, any tax paid in 172 shall be treated as payment as advance tax. If there is a short payment, assessee shall be liable to pay interest in 44B or C. If there is excess payment, assessee shall be entitled to interest on excess refund. Example, if departure of ship from India port takes place on 20th Feb, the owner of ship may by 31st March claim that assessment is made on him in accordance with other provisions of the Act, many other provision is 44B. Section 44B only overrides the PGBP head, Section 28 to 43A. It does not override Chapter 6, set off carry forward. Hence, brought forward business laws can be set off against income computed under Section 44B. However, unresolved depreciation under Section 32(2) cannot be set off against this income because this section has been overruled because it's a part of head of PGBP head. Section 172 is a charging and recovery provision in respect of shipping income of NR arising from carriage of goods shipped in India. However, Section 44B is a charging section in respect of shipping income of NR arising from carriage of ship in or outside India. Section 172 overrules the entire Act. Hence, tedious provisions also do not apply. The payer is not required to withhold tax on payment made to NR or his agent. Hence, Section 195 or 194C, as the case may be, shall not apply. Tax rate applicable to foreign company is 35% plus surcharge applicable to foreign company and cess. Let's see the difference between 44B and 172. So under 44B, two types of incomes are covered. It covers amount received or receivable for carriage of goods shipped from any port in India or shipped at any port outside India. But 172 only covers first type of income. It covers amount received or receivable for carriage of goods shipped at any port in India. It does not cover second type of income. The presumptive rate is same under both the sections, 7.5%. 44B does not have procedure for assessment or collection of tax. But 172 is a complete code in itself for taxation of occasional shipping business of non-resident, including assessment and collection of tax. Under income, if income is computed in Section 44B, the normal tax rate shall apply. However, in case income is computed in Section 172, flat rate of 35% plus applicable surcharge tax shall apply. That is rate applicable to foreign company. So under 44B, the normal tax rate as applicable to the assessee shall apply. If the assessee is individual, then his income is taxable on slab rate. But under 172, even if the assessee is individual, the tax is levied at the rate of 35% plus applicable surcharge tax as is applied to foreign company, as is applied in the case of foreign company. Section 44B overrides Section 28 to 43A. However, 172 overrides the entire Act. So 44B overrides the PGBP head rather, but 172 overrides the entire Act. Since it only overrides the PGBP head, the current year loss or brought forward losses can be set off against under Chapter 6 against the income determined in Section 44B. However, since 172 overrides the entire Act, No set-off is permissible neither for another depreciation nor for current year or brought forward losses. Similarly, 44B only overlooks the PGBP head. Deduction under Chapter 6 are available. But 172 overlooks the entire act. Therefore, deduction under Chapter 6A are also not applicable. Payer of income to NR is required to withhold tax under Section 44B. In case of 172, payer is not required to withhold tax. And the freight include damage charges, handling charges, any other similar amount. The same as 44B and also for 172. In case of 172 also, amount include damage charge, handling charge, or any other similar amount. Clear? So whenever a ship is departed from Indian port, it has to comply with 172. But once it is compliant with 172, it can opt for 44B. Why will opt for 44B? Because there's some benefit in 44B. What are these benefits? Under 44B, I am allowed set off which is not there in 172. Then under 144B, I am allowed deduction under chapter 6, which is not there in 172. Then under 44B, I am taxable at the rate applicable to me. Under 172, I am taxable at the rate of 35% as is applicable to a foreign company. Clear? Now 44BBA, airline business of non-resident. So unlike shipping business, there is only one section for airline business, 44BBA. For shipping business, there are two sections, 44B and 172. So there is no similar corresponding provision of 172 in case of airline business. So it says, notwithstanding anything contained in section 28 to 43A. So it again overrules the entire PGBP head. In case of non-resident carrying on airline business, 5% of the following amount shall be deemed to the PGBP. The amount is same. Amount received in or outside India for carriage of passenger, livestock, mail, or goods from any place in India, or amount received in India for carriage of passenger, livestock, mail, or goods from any place outside India. Clear? In case of shipping, also 44B used to cover these two amounts. 44BBA also covers these two amounts, right? However, for 44B, the presumptive rate was 10.5, but here the presumptive rate is 5%. Forty-four BBA overrides the PGBP head. It does not override Chapter 6 set off. Hence, brought for business loss can be set off against income computed under Section 44 BBA. However, another depreciation section 32(2) cannot be set off against this law. Now, next presumptive section. It's about turnkey power projects. It's applicable only in case of foreign company, not all the NRs. Right? So it says 44 triple B. In case of foreign company, engage in the business of civil construction or business of erection of plant and machinery or testing or commissioning thereof in connection with a turnkey power project approved by the central government. Presumptive rate is 10% of the amount received by SIC in this behalf shall be deemed to be the PGP. C, important thing. Here 44 triple B gives an option to SIC to claim lower profit if it keeps and maintain books of account and get his account audited. Such an option was not there under Section 44B and 44 BBA, shipping and airline business. Now we are moving to 44 double B. Profit and gain in connection with business of exploration sector of mineral oil. Here also tax presumptive rate is 10%. What it says: in case of non-resident engaged in the business of providing services or facilities in connection with or supplying plant and machinery on hire, used or to be used in prospecting for extraction of or production of mineral oil, 10% of the following amount shall be deemed to be the PGBP. What? Amount received in or outside India for the aforesaid activity undertaken in respect of prospecting, extraction, or production of mineral oil in India, and amount received in India for the aforesaid activity undertaken in respect of prospecting, extraction, or production of mineral oil outside India. Either these activities are being taken in India or the amount is received in India. In both cases, 10% of such amount shall be deemed to be the PGBP. Here also, the Act gives an option to the assessee to claim lower profit if keeps them in the books of account and get them audited. Section 44BB does not apply where the provision of Section 115A and 44DA applies. Now, 44BBC, profit and gains of business of operation of cruise ship in case of non-resident. So, if you remember in case of under Section 44B, it's specified it does not apply to cruise ship as referred to in 44BBC. So, in 44BBC, the presumptive rate is 20%. So, firstly, we saw 44B 7.5% for shipping, then 44BB 5%, right? On airline. Then the rate doubles for turnkey power project or exploration of mineral oil from 5 to 10. Now the rate again doubles from 10 to 20 in case of cruise ship. So in case of non-resident engaged in the business of operation of cruise ship, 20% of the following amount shall be deemed to be the PGBP. Amounts are same. Amount paid or payable to assessee or to any person on his behalf on account of carriage of passengers, and amount received or deemed to be received by on behalf of assessee on account of carriage of passengers. However, to qualify under Section 44 BBC cruise ship, the non-resident has to operate primarily a passenger ship having a carrying capacity of more than 200 passengers or length of 75 meters or more for leisure and recreational purposes and having appropriate dining and cabin facilities for the passengers. Non-resident has to operate such ship on a scheduled voyage or short excursion touching at least 2 seaports of India or same seaport of India twice, and operate such ship as per the procedure and guidelines, if any, issued by Ministry of Tourism or Ministry of Shipping as the case may be. Right? Now, one benefit is given. The lease renter paid by a foreign company which opts for presumptive regime under Section 44 BBC will be exempt in the hands of recipient company under Section 1015B if such company is a foreign company and both these foreign companies are subsidiaries of the same holding company. This exemption available up to assessment year 2030 to 31. Okay. So last presumptive section is 44BBD. It is in respect of profit and gains of non-resident engaged in the business of providing services or technology for setting up an electronic manufacturing facility in India. What it says? A non-resident engaged in the business of providing service or technology in India for setting up an electronic manufacturing facility or in connection with manufacturing or production or producing electronic goods, article or thing in India, to a resident company which is establishing or operating electronics manufacturing facility or a connected facility for manufacturing or producing electronic goods, article or thing in India, under scheme notified by the central government in the Ministry of Electronic and Information Technology, MITI, and the resident company satisfy the condition prescribed in this behalf. Right? So in such case, 25% of the receipts are treated as profit. The presumptive rate, the profit and gain shall be deemed to be equal to 25% of the following amount. amount paid or payable by a non-resident assessee or to any person on his behalf on account of providing service or technology, or amount received or deemed to be received in India by the non-resident assessee on behalf of non-resident assessee on account of providing service or technology. Right? The provision section 44DA and 1158 do not apply in respect of income covered by this section. No set of another depreciation brought forward loss would be allowed to the assessee. Right? So this completes the presumptive rates applicable in case of non-resident. Now we are moving to relevant provisions of capital gain applicable in case of non-resident. Okay. So first such provision is first proviso to section 48. What it says, capital gain arising to non-resident assessee from transfer of capital asset being shares or debenture of an Indian company. If the non-resident assessee has a share debenture of an Indian company and he transfers a share debenture, and if the share debenture was purchased in foreign currency, then capital gain shall be computed in such foreign currency only, and the capital gain so computed shall be reconverted into INR. So for such reconversion, for computing the capital gain, the cost of acquisition shall be converted at average TTB and TTC SR on the date of acquisition. The expenditure incurred on transfer shall be converted at average rate of TTB and TTSR on the date of transfer. The full value of consideration also converted at the average rate of TTB and TTSR on the date of transfer. And capital gain, so computed in foreign currency, shall be reconverted into INR at TTBR on the date of transfer. Right. The aforesaid manner of computation shall also be applicable in case of every reinvestment made in share debenture of an Indian company. So even if, so first point is applicable only if the share debenture was purchased in foreign currency, but it also allows that it shall also be applicable if the share debentures are reconverted. Right? However, first proviso is not applicable in respect of capital gain arising from transfer of long-term capital asset referred to in section 112A, listed shares. Now it says, first proviso is applicable to all assessee by the individual or company who is non-resident. Assessee should be non-resident on the sale of capital asset. However, shares or debentures should be purchased in foreign currency. First proviso is applicable when share debenture are purchased in foreign currency or in the case of reinvestment. First proviso is not applicable on units of UTI or mutual funds. They are applicable only on shares or debenture. Debenture include bond, however, bond of central government, state government, and RBI are excluded. First proviso is applicable to listed or non-listed shares or debenture. It does not make a difference. This is applicable whether the asset sold is short-term or long-term. First proviso is mandatory and not optional. Right? Now, another benefit is given in case of rupee denominated bond by way of fifth proviso. Right? It says, in case of an assessee being a non-resident, any gains arising on appreciation of rupee against a foreign currency at the time of redemption of rupee denominated bond shall be ignored while computing the gains consideration. Clear? Now, Vodafone. So what happened in Vodafone? So facts for the Vodafone. It says, Hassian SR Limited, HEL, a company incorporated in India, was in the business of providing telecommunication service in India. Right? So Hutch was providing a telecommunication service in India. CGP, a Cayman Island company of Hutchison Group, indirectly held 67% shares in HEL. Mhm. The shares of CGP was acquired by Vodafone Netherlands. Indian Tax Authority held that Vodafone was under an obligation to withhold tax under Section 195. Accordingly, notice was issued to Vodafone under Section 201 for failure to deduct tax on payment for the same consideration. Vodafone moved to the High Court, Bombay High Court, challenging the jurisdiction of Indian Revenue to examine the transaction. The High Court dismissed the above with petition, against which Vodafone preferred an appeal to the Supreme Court. Right. So Vodafone lost its case before the Bombay High Court, but it won in Supreme Court. What is the decision in the Supreme? Supreme Court held that Vodafone was not required to withhold tax. The Supreme Court held in the favor of Vodafone. It was held that revenue should apply the look at test to ascertain the true legal nature. Revenue may invoke substance over form principle only if indirect transfer is made by non-resident through abuse of organization or legal form and without reasonable business purpose. Strategic foreign direct investment coming to India as an investment destination should be seen in a holistic manner. These are all the observations of Supreme Court. While doing so, the revenue or the courts should keep in mind the factors like duration of time during which the holding structure exists, the period of business operations in India, the generation of taxable revenues in India, the timing of the exit. All these factors play an important role to determine whether the transaction is genuine or preordained. The difference between the preordained transaction created for tax avoidance and a transaction which evidence investment to a particular to participate in India. Section 911 is a deeming provision. A legal fiction cannot expand by general purposive interpretation. The word indirect qualifies income and not transfer. The Supreme Court said that the word indirect used under Section 911, it only qualifies the income and not the transfer. So it covers indirect income. It does not cover indirect transfer. The words underlying asset do not find place in Section 911 and cannot be read therein. The fact that the underlying asset has been sold. This and such underlying asset, sale of such underlying asset can be taxed in India. This line of argument was rejected because the Supreme Court said that 911 is a deeming provision, legal fiction. And legal fiction cannot be expanded. So if it says only assets situated in India, it means assets situated in India. It cannot be indirect transfer or the underlying asset. A controlling interest is an incidence of ownership of share, which is not an identifiable or distinct capital asset independent of holding of shares. So once you hold a share, you have a controlling interest. Because controlling interest goes with the share holding. It is not independent of shareholding. It cannot be that you hold the share and I have the controlling interest. Now, it says capital gain rising through or from transfer of capital situated in India would be deemed to accrue as rising in India. This is Section 911. So there was estimated capital gain of $2 billion accrued to Hutch in the above transaction. In terms of aforesaid decision of the Supreme Court, it follows that tax planning within the framework of law is not frowned upon and only if artificial or colorable devices, sham transaction, are resorted to with the sole purpose of evading tax, that the revenue could ignore the same. The onus is on the revenue to establish that the transaction was a sham and not on the assessee. It was noted that the foreign investor investing in India through companies interposed in Mauritius is a common practice for both tax and business purpose. For example, such companies are interposed to avoid lengthy approval and registration process. So it says that foreigners invest through Mauritius, not only for tax purposes, but also for business purposes, because they want to avoid lengthy approval and registration process, which is required in case of direct transfer. So this by itself proves that the structure is not only influenced by the tax motive, thus it facilitates the exit of foreign investors. In terms of aforesaid reason, it appears that the aforesaid reason may well afford a business or commercial purpose for having intermediary entities in an investment structure. According to the court, when it comes to taxation of a holding structure, the burden is on the revenue to allege and establish abuse in the sense of a tax avoidance in a creation and or use of such structure. Such structure are to be otherwise respected. The court said, unless the revenue prove that such structure are used only to evade tax, such structure shall be respected. The Supreme Court further held that where an entity which has no commercial or business substance and has been interposed only to avoid tax, then it will be open to the revenue to discard such entity, applying the test of fiscal nullity. However, the structure of the transaction need to be disregarded at the threshold level. The Supreme Court further cautioned that while doing so, the revenue should look at the document and not look through the document. And the revenue should look at the document or look at the transaction in context to which it properly belongs and as a whole instead of adopting dissecting approach. They should look at the transaction as a whole and not take a dissecting approach. These are all the observations of the Supreme Court. So, basis this decision of Supreme Court, some amendment was made to overrule the decision. The first amendment was made in the meaning of capital asset under section 214. So it says property includes any right or in relation to an Indian company, including right of management or control any other right first. So you remember, Supreme Court said that controlling interest or a controlling right is not, however, is an independent right, separable from the ownership of the share. It's embedded into the ownership of the share. It comes with the ownership of the share. But now, section 214 says, capital asset, property includes any right in relation to an Indian company, including right to management or control or any other right whatsoever. So, the Parliament has made such right as an independent right. This is to overrule that observation of Supreme Court. Right. Meaning of transfer, so section 247, amendment is made in the meaning of transfer. The definition is expanded. Transfer includes disposing of or parting with an asset or an interest therein, or creating any interest in any asset in any manner whatsoever, directly or indirectly, by way of agreement, whether enter into India or outside India, or otherwise. Notwithstanding such transfer of right has been characterized as been effective dependent upon flowing from transfer of share or shares of a company registered or incorporated outside India. So it says if there is a transfer of shares of a company outside India and pursuance of such transfer, there is a transfer of controlling interest in any other entity, then such transfer shall be treated as a transfer for the purpose of section 247, that is for the purpose of capital gain head. So two things amended. Definition of capital is enlarged and definition of 247A auto expanded. 247. Section 9. The expression through shall mean and includes by means of, in consequence of, or by reason of. Then the definition of through, the meaning of through has been given in a very wider form. Now it says a capital asset being any share or interest in a company or entity registered or incorporated outside India shall be deemed to be situated in India if the share or interest derives directly or indirectly its value substantially from the asset located in India. Clear? It says even if the shares of foreign company shall be deemed to be located in India when if such shares derives directly or indirectly its value substantially from the asset located in India. So in such case, shares of foreign company shall be deemed to be situated in India. And in such case, transfer of such shares shall, when capital gain on transfer of such shares shall be deemed to accrue or rise in India. Once the capital is situated in India, then capital gain on transfer of such shares is deemed to accrue or rise in India. So it says shares of foreign company shall be deemed to accrue or rise, shall be deemed to be situated in India if they derive value directly or indirectly substantially from the asset located in India. No income arising from transfer of asset referred to expression 5 shall be taxable in India. Benefit provided. It says expression 5 shall not apply. So no income arising from transfer of asset referred to expression 5 shall be taxable in India if transfer is made by a non-resident or of a capital asset being investment in category 1 FPI or transfer made by a non-resident outside India if the transferor, whether individually or along with AE, at any time in 12 months preceding the date of transfer, neither holds the right of management or control in relation to such company or entity, nor hold voting power, share capital, interest exceeding 5% of the total voting power or share capital total interest, as the case may be of such company or entity. So in these cases, expression 5 shall not apply. Now it says, where all the assets owned by the company or entity referred to in expression 5 are not located in India. So it may happen that substantially the assets are located in India of the foreign company, but not all. Then the income of non-resident transferor from transfer outside India of share or interest in such company or entity, as the case may be, shall be only such part of the income as is reasonable attributable to assets located in India and determined in such manner as may be provided. Then the entire income shall not be taxable in India and only a proportionate income shall be taxable. Such proportion shall be determined according with the method prescribed. The share or interest referred above shall be deemed to derive its value substantially from asset, whether tangible or intangible, located in India, if on the specified date the value of such asset exceeds 10 crore and represent at least 50%, substantially means 50% of the value of all assets owned by the company or entity, as the case may be. So if the value of the asset less than 10 crore, then these provisions shall not apply. Value of asset shall be the fair market value as on the specified date of such asset without reduction of liability, if any, in respect of asset determined in the prescribed manner. Now, what is specified date? Specified date means the date on which the accounting period of the entity ends, preceding the date of transfer of a share or interest. Right. So, if the shared interest is transferred in April, then the specified date is 31st March. Okay. The preceding date on which the earlier accounting year ends. However, the date of transfer shall be a specified date. So this benefit shall not be given and the actual date of transfer shall be deemed to be specified date of valuation in a case where books value of the asset of entity on date of transfer exceed by at least 15% the book value of the asset as on last balance sheet date preceding the date of transfer. So first it gave an option that you can take a specified date as a balance sheet date, last balance sheet date. So if the asset is transferred on, say, June 25, the specified date shall be 31st March 25, right? So asset may be transferred anytime between 25-26. The specified date shall be 31st March 25. However, it says the specified date shall be the actual date of sale of the asset if the value of the asset as on 31st March 25 and the value of the asset and on the date of transfer. There is a difference of 15% or more. So the asset has increased by more than 50% from the last balance sheet date as on the date of transfer. Then the last balance sheet date cannot be considered a specified date, and the date of transfer shall only be considered a specified date. That's what it says. Specified date means the date on which the accounting period of the entity ends, preceding the date of transfer. Okay, so whenever the shares are sold in the year 25-26, the specified date shall be 31st March 25. However, the date of transfer shall be the specified date. However, the benefit of balance sheet date shall not be available and actual date of transfer shall be a specified date. In a case where book value of the asset of entity on the date of transfer exceed by at least 15% the book value of the asset as on the last balance sheet date preceding date of transfer. So if the balance sheet has increased by more than 15% between the balance sheet date and the date of transfer, then the specified date shall always be the date of transfer. However, if there is no such major difference in the valuation, then assess an option to take the specified date as the last balance sheet. The share or interest above shall be deemed to derive its value substantially from asset located in India if on the specified date the value of such asset exceed 10 crore or represent at least 50% of the value of all assets owned by the company or entity as the case may be. Lastly, it is clarified that dividend declared and paid by a foreign company outside India in respect of shares which derive their value substantially from assets situated in India would not be deemed to be income accruing arising in India by virtue of provision of Section 5 to Section 911. So it says this exemption, this assumption that the shares deriving substantial value from asset in India shall be deemed to be located in India is only for 911. It is not for dividend. So even if the shares of foreign company derive substantial value from Indian asset and they are deemed to be located in India, still the dividend paid by foreign company shall not be deemed to accrue or arise in India. Clear? So we'll conclude our class on this note, and in the next class we'll complete the NR chapter and the last chapter and the double taxation relief chapter. Okay? So thank you for today. Good night. So class concluded. Thank you.